for the we are discussing about the mutual fund. So our main topic is what is the mutual fund and how the investments happen, how the mutual fund works, and everything we try to cover in our topic called mutual fund. So everyone in daily life hear the word called mutual fund. So in fact, I've also heard many times what is the mutual fund, but the guys who is non-financial, he don't aware about the financial terms. He got some confusion. So I tried to search what is the mutual fund. So I got some information, and I feel that it appropriate to provide this information to our audience that they can aware about what is the mutual fund. They can make the better investment choices if they find the mutual fund is the best. And also mutual fund is less risky option as compared to the stock market investments. So that we will cover. So our first agenda of this topic is what is the mutual fund. Then we understand how the mutual fund works and what are the different type of mutual funds. And third one is I try to provide you the ample amount of the tips, bonus tips. So let's start it. So the mutual fund, what is the mutual fund? So mutual fund is a type of fund that that is the fund that the investment, it's kind of an investment that is collected, that is the assets, like our assets might be any type of assets. So the mutual fund is a type of assets. So it is a type of assets, and it is collected from the investors. So investor from like I, you, and everyone, if they invested in the mutual fund. So all these funds, all these public funds are collected. So it is called as a mutual. Mutual means it's all collective funds collected from the all public. So it is the mutual fund, and it is the assets. It is type of assets collected from the people to invest in the securities, to invest in the assets, to invest in the equities, to invest in the stock, to invest in government securities. So this is a general term. This is the basics of the mutual fund. So what is mutual fund? It is assets. It is collected from the normal public, and it is invested in the government securities, stocks, and debts, bonds, various type of instruments, investment, various types of investment. So this is about the mutual fund, and now how the mutual fund works. So the mutual fund is the organizations, is the company, so who have the rights to collect the mutual funds. So there are the asset management companies, AMCs. The asset management companies hold the right to form the mutual fund companies, to form the mutual fund, to collect the investment from the investors to invest in the mutual funds. So this asset management companies holds the right to collect the assets from the investors to invest in the securities, bonds, etc. So this asset management houses, they are the firms, we can call as the financial firms. So how the asset management works, so how the mutual funds works here. So let's take an example. I am the investors, and let's take an example. I choose the XYZ company of the mutual fund, and I want to invest in that mutual fund. So I invested the 500 rupees. Okay. So this 500 rupees is my principal investments. So how my investment got diversified? How can I get the profit wins from this mutual fund? So there is a term called as a net asset value, NAV. NAV is the value, that is the price of the mutual fund assets that is have the current value. So every day this NAV, net asset value, is changing dynamically. So like a stock market, if let's take an example of ABC company, that yesterday the price was not same as today, and tomorrow the price may not be same. It is changing. It is dynamic. Same thing applicable for the mutual fund. So there is a term called as NAV, net asset value. So that is also changing. So if you try to invest in the mutual fund, the the units that mutual funds you are allocated based on the NAV. So let's take an example. The NAV for the XYZ company. So for the XYZ mutual fund is rupees 10. 10 rupees is the NAV, and I am investing 500. So 500 by 10. So that 500 by 10. So that 100 units I'm getting the 50 units I'm getting. So 50 units is my units that I'm getting from the mutual fund. Likewise, if you purchase the stocks from the stock market, you get the number of stocks. So the number of shares. So let's take an example. If you are investing, you supposed to buy the 100 shares of 10 rupees each, then you need to invest 1000. So the 1000 rupees is your investment, and the number of shares you are getting is 100. So same thing is applicable in the investment, in the mutual fund investment. So let's take an example is NAV is 10, you are investing 500, then you are getting the 50 units. Let's take an example, the NAV. So you have purchased, and let's take an example, if certain amount of time, or certain, depending upon the investment type of the mutual fund, on the maturity level, the NAV got changed. So today the NAV is 10 rupees. So if tomorrow, in a certain period of time in the future, if NAV goes from 10 to 20, then your profit will be multiplied by 20. So let's take an example. The profit you will get is, you have invested initially the 500 rupees and multiply by 20. So you will get 10,000 rupees is your net. 1,000 rupees is your net profit. What can I say? So you invested initially 500, and you get the 500 as a profit. So total 1,000 you got the profit. So NAV, you got the term that what is called as NAV, net asset value. So now next we understand the NAV, and now we can try to understand how the mutual fund works. So there are the called as fund manager. So you do not need to time the market to the mutual fund. So let's take an example. I invested in the mutual fund. Let's take an example of 500 rupees I invested in the mutual fund. So I do not need to select the investment types that I need to invest to get the maximum benefit. So let's take an example in the another type of investment. So in India, there are basically 3 to 4 type of the what we can say as conservation type of the investments. So first is your bank deposit, saving accounts. So there is a fixed deposit. So there are the fixed number of years that you are investing. Let's take an example of 5 years, 10 years. Then there is a gold investment in the gold. Then depending upon the price changes in the gold, you will get the profit. And then third one is the stock market. So apart from that, the mutual fund is gaining the popularity in the last 10 decades, 10 to 20 decades. So this mutual fund is most promising and less risky type of investment as compared to the stock market and other type of investments. So let's take an example. We have discuss about the NAV. So how this fund is get diversified, when how one can get the benefit, how the investment you will get the high returns as compared to a saving account. If in the fixed deposit, if you are getting the 7% of the interest rate per annum, same in the mutual fund you will get 12, 15, 17, 20% depending upon your assets performance. So let's discuss about how the mutual fund works. So the investment of the public is collected in one place, and then the person called as fund manager, he is a person that holds the right to invest, to diversify your fund, to invest your fund in different category of the securities. So let's take an example. The fund manager invests the stocks. So 70 to 80% will be invested in the large cap companies in the stock market. 30 to 20% will be invested in the government securities. So In this ways, if depending upon the asset performance, if that asset perform well, if the stock perform well, then it will get added in your mutual fund. Then your mutual fund will get valuation of your mutual fund will grow, and you will see the positive growth in your portfolio. Same as the stock, if that particular equity or the stock is underperforming, not performing well, then the same way you will get a reflection of the losses in your portfolio. So it depending upon the asset. So, and you must be realize that the fund manager take care of your fund. So don't worry about the investment portfolio or diversification. The fund manager will do that. So in this way the mutual fund get diversification. So now we will move on the classification of the mutual fund. So basically there are the different type of categorization, classification. So based on the structure, based on the types. So let's take an example based on the structure, asset structure. Based on the asset structure, there are the two types of the mutual fund. So one is open-ended and another one is closed-ended. In the open-ended mutual funds, you will there is no maturity amount, maturity limit. What can I say? If you invest your stock for this, so today you invested in the mutual fund, tomorrow you can sell. There is no maturity limit. So the advantage of the open-ended mutual fund is that you can redeem anytime you want. If you need some money, you can redeem. If you find the NAV is increased, you can sell this for your mutual fund when you find that this is the right time. So there is no limit on the maturity. So this is the open type of open-ended mutual fund. Second one is close-ended. So in the close-ended mutual fund investment, there is a certain limit to the maturity. So let's take an example. You invested today, then there is a maturity limit of per se 3 years. So unless and until you complete the maturity period, you cannot sell your stock mutual fund. So that is the boundary of the close-ended. So in the close-ended, the disadvantage is that you need to stay until your maturity period, and then and only you can redeem after the completion of the maturity period. So that is the two type of the mutual fund, is open-ended and closed-ended. Now the mutual fund is based on the asset type. Okay. So based on the asset type, there is 3 to 4 types of the mutual fund. So one is the large cap mutual fund. So large cap mutual fund is basically the fund that is invested in the large cap companies. So the companies that have the high market capitalization. Let's take an example. In the Nifty, there are the 100 listed companies that has the top. That is the India's topmost market cap companies, and that companies are always be in the profitable, and they are a very secure company. There is a minimum or minimal chances of the losses because they are the well established in the market. So these are the big companies which have a high market cap. So generally 70 to 80% of your fund is get invested in the large cap fund to minimize the losses. Then another is the mid cap companies. So mid cap fund, mutual fund is invested in the mid cap companies. So mid cap companies has the medium medium valuation of the market capitalization. But these companies are less risky as compared to small cap. But yes, mid cap companies are also the promising companies that will be the future of large cap companies. So there is no need to worry about when someone, your fund manager, invested your certain amount of money in the mid cap. So mid cap fund is less risky. That's small cap. And then third one is a small cap fund. So small cap fund is kind of a mutual fund that invest your asset in the small cap companies. So the small cap companies are the new startup companies, that are the new company in the market that are introduce their products. So the small cap companies has the riskiest company because of they are still has to establish in the market, still have the scope to grow, but there is a chances of the losses. There are the chances of the growth multiple in the if there is a growth, then there is a you might find big valuation, big benefit from the large cap in the small cap as well. But the risk factor, yes, risk factor is high. So depending upon the risk factor, the fund manager invest depending upon the portfolio. Either he invests 70 to 80% in the large cap companies, 80 to 50 to 45% in the middle cap, and 10 to 15% in the small cap. So this is called as the portfolio diversification. So we have seen the type of the mutual fund based on the asset types, and there are the number of mutual fund like ELCC that is aim for the tax reduction. If suppose let's take an example, you need to save your tax, then there is a maturity period called 3 years per se. If for the 3 years you invested your certain amount of fund in the ELCC, then you will get the annual tax benefit of 1.5 lakh rupees. So that is the benefit of the ELCC. So that is kind of a mutual fund. And there is a hybrid mutual fund. The depending upon the risk factor, let's take an example: the high aggressive mutual fund, aggressive type of mutual fund. So aggressive type. So why I term is as aggressive type? Because 80 to 90%, 80 to around 75 to 80% of your fund is invested in the small cap fund. That is riskier. Because of mid cap. Let's take an example: your 70 to 80% of this fund is invested in the stock market, which is might be 10 to 80% in the large cap, 15 to 55% in this mid cap, and 10 to 20% in the small cap. So basically, these are the aggressive investment because they are giving you the aggressive benefit, aggressive loss as well. So why the term called associated with the aggressive is that because of the stock, the investment type is purely your mutual fund invested purely in the stock. So in the stock there is the chances of the profit, and there might be the losses. So these are the aggressive. The momentum of the stock market is very huge. If you see today, just tomorrow the price may be drastically change. So there is a drastic dynamic movement in the price. So it is called as the aggressive type of investment in the mutual fund. Then second type is less aggressive. We can term it as a mid aggressive. It's not much. Means your stock still invested in the stock market, but the proportion is less. Let's take an example: 30% of your asset is invested in the stock market, remains 70% your investment is invested in the security bonds. So that kind of the diversification is called as a less aggressive, or the medium kind of aggressive. The third kind of is very less, means a kind of a numb, or you can say no risk. So if the interest rate will vary, if the interest rate vary in the future, there is a minimum impact to your stock. So these are the type of investment that the corporate mainly invest their mutual fund for the 1 day. So the maturity period of this stock is 1 day, and it is a benefit for the corporates that they want to keep their funds secure for a couple of days or 1 day to take the maximum benefit. So that kind of investment is called DEB. So in a DEB and security investment, so DEB and security investment is a kind of investment that your fund manager invests your stocks totally on the DEB, not the stock market. So there is a bare minimum loss, minimum chances of the loss, and the chances of the profit is high. So in order to diversify your portfolio based on your risk, so depending upon you which kind of the type of investment you seek for. If you are the kind of person that you want the big sum of the money in the minimum amount of time, if you want to quantify your profit in a minimum amount of time, then the aggressive type of investment will be recommended by your fund manager, and your fund manager will do that for you. And if you are the kind of person that no, I do not want the risk, I want to minimize my risk and want to make the profit. So in order to minimize your risk, then your fund manager will invest only in the securities or the government bonds. That is the most secure type of investment. So this is the kind of investment that you can plan for. You need to give your choices to the fund manager what kind of fund, and you need to also read some laws. So there are also the term called as a tax in the mutual fund. So tax law, you need to understand what are the various type of taxes. So basically there are the two types of taxes, CGST and LTCG. So CGST is a short term, SGST is a short term kind of law taxes that are applicable for the mutual fund that are ready, that are mature in the short term. Let's take an example, within the 91 days if your maturity period is over, then this ESG short term taxes will be applicable for you. So this taxes, the amount is also vary upon based on your type of the investment. And then there is a long term tax that will be charges by the government. So that is the charge that if you hold your security for the long term, let's take an example, for more than 5 years, if you hold certain kind of mutual funds for that period, and then if you redeem, then based on this type of asset you get taxed. So there is a tax involved depending on maturity. If you do not redeem or do not sell your mutual fund, then you will not taxable. But yes, certainly there is a tax involved, so you need to read and I understand what are the various kind of taxes before making an investment. So there are the bonus tips. Now we will move toward the bonus tips. So the bonus tips number one, understand fully the mutual fund. So I recommend you, before moving to the mutual fund investment, you need to understand the basics of the mutual fund that you are going to invest. Read all the tax laws, read all the information that the maturity, the kind of what kind of the mutual fund is, it's open-ended or it's closed-ended. You need to compare the your choices. If you need to invest your fund for certain amount of time that you don't require, then you can go for the closed-ended. If suppose you want to diversify, you need the fund and you want to make the short-term make investment for the short amount of time, then you can opt for the open-ended. So based on your choices. So first of all, understand our choice. Clarify our choice. What I need to understand is the long term or the short term. Second tip is go for the long term investment. So I recommend you that for the long term there is a bare minimum risk and high opportunity of the maximization of the profit. So if you don't require your fund for the for certain let's take an example, if your fund is dead and you don't require for certain period of time, then you go for the long term investment. So that will be benefit for you, as well as you can also take the benefit of the taxes. So under ATC you will get the tax exemption. So that is the benefit of a long term. So I will I will recommend you to go for the long term. Then third one is the SIP type of investment, like SIP and lump sum. So SIP is a kind of a investment that if let's take an example, I want to invest the 1 lakh, but I don't have that much amount, then I will go for the monthly investment. Let's take an example, 10,000. So I will invest monthly 10,000 for the for certain amount of period, so that I can get the benefit of the mutual fund. So the SIP is I will recommend you opt for the SIP, because SIP is the fund that will also maintain your cash flow. It will not burden you if you invest certain amount in one go. That is called a lump sum. That will again, it will depend upon your financial situation. If you have the lump sum amount of money, you have certain amount of cash flow, then you can go for the lump sum investment, or otherwise I recommend you to go for the SIP. So the benefit of SIP is it will make you the what can I say, disciplined investor. You are disciplinedly, you are taking some sort of amount and invest regular time of in a monthly. So you will become a disciplined investor. So that is the benefit of the lump sum. Then the bonus tips. The third is to understand the tax laws. There are the tax rules, different tax rules that will not probably told by your portfolio. What can I say? Any agent will come to you and recommend you to invest in this fund, or some person from the mutual fund that might not be give you the detailed knowledge about the tax. So I recommend you to first understand the tax rule. So that is important, because your mature amount will be taxable. So apart from the tax, so on the taxable, what amount I will get. So you need to consider that, and based on that you need to decide where to go, which investment you opted for, or the based on if you suits the taxes is bare minimum, then you can opt for. So basically, the tax rule is very important to understand before investing in the mutual fund. Then the bonus tip number five is you need to understand, you need to diversify your portfolio. So the diversification has a two advantage. One is it is high profitable, and second one is bare minimum risk. So there is a minimum risk while you diversify your portfolio. So I recommend you to diversify so that your 60% your amount will be invested in the large cap fund, then your 30% will be invested in the mid cap, and 10% will be in the small cap. So likewise, you can diversify your fund, and you will make and just you will inculcate a minimum risk while diversifying. So in the diversification, there is a benefit. One is you can get a maximum benefit, and another one is you will be less liable to the losses. So that is the bonus tips. So and also I recommend you to read various articles based on the mutual fund, and documentation. If someone came to you, if you decided to invest in the mutual fund, then you need to identify which type of investment. To clarify your goal to invest in the mutual fund, so that is very important to clarify. Okay, I want to invest for the 5 years, and I need to get this benefit. Let's take an example. If for the 5 years I want to invest 1 lakh rupees for the 5 years, and after 5 years I need to double my diversification, double my investments, like 2 lakhs. So in this way, you need to clarify yourself that how much the amount you need to invest and how much you are planning. So the planning is very important. Pre-plan. Don't go blindly. You need to plan yourself how much and what the type of investments, the mutual fund you need to go for. And yes, I will recommend that compared to the traditional investment instrument that are available in the market. So compared to your saving fixed deposit, compared to your gold investment, yes, the mutual fund is much better than the fixed deposit scheme, much better than the gold, and much riskier than the stock market. The stock market has the risk, it has the profit, but it has liabilities and risk. But in the mutual fund, there is a minimum, say, no risk or minimum risk and high chances of the profit. So go for the mutual fund, and I hope this video will help you and guide you to consider your when you considering your investment in the mutual fund. You will take my points and make your judgment according to that. So I hope this video will helpful. Thank you.